Welcome to the Daily Update, where I'll go over the action in the market for Monday, June 3rd, and then we'll see how things look for Tuesday, June 4th. We saw early weakness, late day strength. That's a positive thing. So we're looking good on one hand. We're above moving averages, both in the short and intermediate term, but we have some of our primary indicators that are looking negative right now. So it's kind of a mixed picture with what's going on in the market. Also know that as of Monday, June 3rd, the SPXInvesting Program has now launched. It's hosted on Substack. We have a chat area. I post different videos like this one, which will only be available to members until after the market closes. I did a number of videos over the weekend, and I spent about 15 minutes in each video re-explaining the program. I get kind of tired of doing that, and I was really losing my voice while doing that. So now I just recorded another video. Here is a link to that particular video. It's posted on both YouTube and Rumble, where you can go check this out and see if it's of interest to you. For the month of June, it will be free. So right now, all you have to do is supply an email address. And if you decide not to be a member later on, you can just unsubscribe, and that's that. Okay, so let's go back and talk about what happened, and then I'll go through some charts. Right at the open, we did have a higher open. The futures were fairly positive. We were up anywhere from a third to even at some point about 0.5% before the market even opened. But we immediately hit resistance at 5,300. That's going to be the next level if the market keeps going up that is really being challenged. In Friday's session, it was around the 5,200 level where we found support. Now we seem to be hitting resistance at the 5,300 level, and we set the high pretty much right at the open. That's why we do things closer to the close as possible, because that's when things are really set. And then we fell down to the unchanged level and the daily pivot at 5,250. Again, it's kind of interesting how they're round numbers also lining up with our different pivot points. Prices finally found support and then rebounded back above the daily pivot and the unchanged level to close slightly positive. So a good late day comeback. We were up 0.11%. We're back to being below average with volume. We saw a huge spike up in Friday's session. Now that was the end of the month and also the end of the week. And so not the end of the quarter, but there may have been some maneuvering going on that caused the volume to be well above average. But in Monday's session, we dropped back down. We're mixed in the short term. It depends on what you look at. On a momentum basis, judging by our moving averages, we're positive. If you look at our momentum oscillators, we're negative. And so there's a real kind of contradictory environment right now. And it's about inflation and interest rates. And it'll continue to be about that. And then we want to keep an eye on all the different geopolitical events, just in case some of those come to the surface and impact the market. Some comments: it was another late day bounce from session lows. We just have our stochastics in the short term that are extreme positive, because that takes a while for that chart to actually work off either an extreme positive or negative reading. The scenario has not really changed. The Fed is keeping rates higher for longer. There was a little bit of concern on Monday that I'll get to in a moment. The ISM manufacturing came in a lot weaker than expected. And now, are we getting to the point where bad news is actually going to drift over and become bad news? We're going to get more reports later on. And if they come in weak, now instead of the economy being too strong, the market may start to be concerned that the economy is too weak. One day, we can't really see that whole shift, but we'll just be watching to see if that's what happens. The reason why they're keeping rates higher for longer is that inflation has been really stubborn or sticky. It has not been coming down to that 2% level that the Fed wants. And as I talked about over the weekend, it's still looking like the possibility of the first rate cut coming in September, but that's going to change a lot. And as we get closer, it'll get more locked in as to what the market is thinking. The dollar was down and interest rates were also down. That gave support to stocks, especially later in the day. We closed at 4.11% for the 10-year yield, where we had been at 4.51%. So interest rates coming down is giving some support to stocks. We're still inverted with the yield curves. Sentiment is still neutral at 51, where after Friday we had been at 48. We're still not trending. The ADX is below 20. It's below its moving average. So we're in a sideways type of an environment right now, but we're negative. That's one of the primary indicators. The red line is on top. So even though we're above some moving averages, this indicator is still leaning more towards negative. The bias, I kept it negative. I could have switched that over to positive, and the momentum, where this early weakness, late day strength, that could be taken as positive, but we're seeing such a mix now with our different indicators that it's hard to really have a consistent bias and momentum one way or the other. The economic reports that came out, I don't have a chart for this one. S&P Global US Manufacturing, the final reading, came in at 51.3. That's above 50, so it's showing some expansion. And last time it did come in right at 50. This was the big one. This is the ISM manufacturing. Kind of measures similar things, but the second report is the more important one. This was weaker than expected. They thought it was going to come in at 49.6. Again, a little bit under that 50 level, but it came in a lot under that at 48.7. Last time we had the report, it was at 49.2. Construction spending was down 0.1%, where they expected it to be up 0.2%. Last time it was down 0.2%. Here are some charts. Here's the ISM index, where we're really dropping off with the total. That's the blue line that's coming down, and we're under 50. The orders are also dropping off. We need to see if a picture is being developed with weakness in the U.S. economy. If you just look at this, yeah, the market is concerned about that, but we need to see the story unfold as additional reports are released. ISM prices and deliveries. Prices did tick down, and deliveries pretty much flat right now. And then the trade, where we have imports and exports. The yellow line are imports. That went down, where exports are actually going up. That could be seen as a strengthening sign in the economy, that we're sending more out of the country than what we're bringing in. Here's the month over month reading here, where it declined and we're still below 50. Here's construction spending, which did come down on a year over year basis. We're looking at a 10% gain though. And private construction spending, when we look at residential, that's going up, and non-residential is actually coming down, and they're just about meeting each other. Here's the month over month chart, where it was negative, but it did improve a little bit from the previous reading. Here's Isabel Net blog charts. This is what we look at as charts are available. These are the buyback authorizations and announcements. This is as of May 24th. This is what we're looking at right now as far as buybacks, and that's seen as something that's pretty positive. This is something that I talk about in every video. I say the yield curves remain inverted. Well, there's two main yield curves that we follow. There's a lot of them that I do track, but for a long time, what a lot of folks were really focused on was the 10 to the 2-year yield curve. That means the 2-year yield is higher than the 10-year yield. That's been inverted, and that went inverted first, and that's been inverted quite a bit longer. Well, then, I don't remember, 6 months or so after that, there's other economists that look at the 10 to the 3-month, and there's this debate that goes back and forth. Which one is best? So I chart them both. And this is still inverted as well. You might want to pause this and just look at different things that ended up happening and what the, not so much happening, but dates, and then what the yields were at that time. Short interest, we do get charts about this every once in a while. On one hand, we see this going up. That means that more folks are actually shorting the market. On the positive side, that means that if we really continue to go up, these folks are going to have to cover. They sell to get in and they buy to get out. We call that a short cover rally. And that's where the market just seems to be going up and up and up without stopping. And the economic surprise here, we have been negative overall, but we're starting to come back up. Now, this doesn't include Monday's economic report. That would probably send this back down a little bit. And this will also be shown in the weekly video. This is the smooth U.S. recession probabilities. We're below the black line and we're well below the red line. That's when we get concerned, when we're above the black line and going up and crossing above the red line. This is falling back, so we're just seeing the probabilities of a recession, according to this chart, really starting to taper off. Then This is year-to-date flows into equity funds by sector. It's not really a surprise. Most money is going into tech, followed by industrials, and we're actually seeing negative across all the other sectors that we look at here. And then this is comparing the really big stocks. I guess this is the, let's see, 2, 4, 6. No, 2, 4, 5. Is this the Fantastic Five instead of the Magnificent Seven or the Great Eight? You see, you can take these things and crunch the numbers a little different way and you get up with different results, but still we're seeing pretty much consistency here where it just shows the return going back to the beginning of the year where Amazon, Apple, Microsoft, Google, and Nvidia, when you put them all together, and most of that's Nvidia really, it's up 27%, where the S&P is up, but it's up 11%, and the other companies in the S&P, they're up as well, but up 6%. I found one interesting chart on Twitter. I've been so busy doing other things for the program. Twitter is kind of a brain dead type of venture anyway, because you get all these people that are, so sure that they're right and they're posting information that they think everybody else needs to see that really doesn't have anything to do with anything. And so I kind of have to be in the right mood to be on Twitter. And I know it's called X now, but I don't care. There was a problem with Berkshire Hathaway. This is Warren Buffett. There was some real messes. So they actually ended up halting the stock. And at one point, they had it down 99.97%. Obviously, that was not correct to fall almost 100% right after the open. So they ended up halting. I think that got worked out later on. But see, I first saw a headline for this on X or Twitter, but you don't know if the stuff that's being posted, there's so much garbage out there, even in the financial area that I hang around in. I don't go to the movies or the politics part, or that stuff's totally insane. You even get, this is how rumors start throughout the stock market. And I tried to verify that, and I didn't find anything by searching a couple of different sources. So I just kind of blew it off. But then later on, I was able to verify that this actually happened. Here's our intraday chart where, again, we gapped higher. We hit resistance right at 5,300. That was the high for the day. And then we started trailing off. And I was posting updates in the chat session when we went negative. Then we came down to the daily pivot. And then this is about where I stopped doing updates because it's like, okay, I want to wait to see if we're really going to come up and go see a nice little bounce going into the close. And that is what we saw. So when you look at the intraday action, this is actually quite positive. It's just when we get to some of the daily charts where we're seeing a real contradiction. And we ended up closing slightly positive with the SPY intraday as well after it had been negative. This is positive here where we're seeing the blue line above the red line. Growth is outperforming value on the intraday chart. And we did see growth to value, the ratio actually going up, meaning growth was outperforming on the S&P intraday chart. So that's positive there. Here's our end of day chart. Growth was up with the large caps where value was down. We were down a lot more with the mid caps and down a bit more with the small cap growth to value ratio. So here's our end of day charts. We ticked up just a little bit, but not showing any strength here with the small caps. Also a little bit of a tick with the mid caps, and actually still seeing a decline with the S&P growth to value ratios. Now, the reason why we're seeing differences here with the closing values and what the charts show and the intraday values, I'm using a bunch of different things. I use ETFs. Some of these are indexes. Some of them are equal weight ETFs. Some of them are weighted. So that's why we get this kind of broad, different view of growth to value. And this is another one. These are some ETFs where this actually ticked up. We came down in Friday's session, but we were able to bounce up off of the rainbow. That's why this is showing a bit of an improvement. When we look at discretionary to staples, just a little bit of a tick up. And we came right up to the moving average with the equal weight discretionary ETF, where we bounced up, but we're still below the moving average with the staples. So right now, discretionary is doing a little bit better when you base it on where it is compared to its moving average. Large cap growth was up 0.68%. We never quite came down to the 50-day moving average before bouncing up off of that. So the large caps, they were the stronger area. The Wilshire, after coming right down, this might have been the support that we set, but the Wilshire usually isn't the real focal point of things. We bounced up off the 50-day moving average. We were barely unchanged, but we were slightly positive on Monday. Here's our trend where we're below 20 and we're below the moving average. So this shows a weakening, non-trending environment. The red line, even though it came down, is still on top, so we still default to positive here. So even though we're looking okay with our moving averages that I'll show you as we go forward here, this is one of the warning signs and something rather negative currently. Here's a look at our short-term chart, also below 20, below the moving average. Red line's on top, but it is declining. Volume really came down. Now, this is an oscillator, so it doesn't just take one day at a time where it's really coming down when compared to last Friday's really big surge in volume. Here's a look at sentiment. We're pretty much sideways, but still under the moving average with the Ulcer Index. Here's a weekly chart showing we're coming in at 76.3. This is a composite where I tend to look at a different kind of composite. This takes the AAII, the bullish percent index, the put call ratio, the active asset managers, and the VIX, and puts them all together. We're just on the border between extreme greed and greed. To me, this would be extreme positive and positive. Don't have a reading yet for this week with Investors Intelligence. They came in at 3.45, so we're still above 3 there. We did get the next weekly chart that we look at of the insider transactions ratio. It's actually coming down, and this could end up being bullish for the market. And here's a look at the insider buying ETF, where it's declining a little bit further below its 50-day moving average. Here is the VIX. We ticked up on a closing basis with the line chart, and we actually closed pretty much near the low with the bar chart because it was really going up as we saw weakness earlier in the day, and then it started coming down as we were bouncing back up. We're also seeing the volatility of the VIX continue to drop, at least on the bar chart, and close closer to the low, but it ticked up when we just look at the line chart. The momentum of the VIX is now positive. It has been going up, and the MACD has picked that up. So the trend has been higher. And the equity put call ratio did decline. We probably saw a lot of hedging that was put on over the weekend come off in Monday's session. So now this is turning a little more positive. The 5-day chart, where it had been going up, which is usually negative, now it's starting to turn back down, which is positive. Volatility risk premium did come down, and we're just at the upper end of this band. We declined with this fear gauge, and we actually ticked up with this other fear gauge. So a little bit of a discrepancy there. This is a little bit of a warning sign. Not huge, but just something to be aware of. We had an up day, but the advanced decline line based on price and volume ended up being down. That just means a few stocks really helped the index to close higher, not all of the S&P itself. We are, though, seeing right after we had that nice open that was a gap higher, we did see an expansion of the new highs. Not enough yet to turn our 5 period back up, and we're still declining with the 10 period, but we're seeing a contraction of the new lows. So this is showing a little bit more strength, but it probably happened with the higher open. We need to see this continue to go up to remain positive. And we're just a little bit negative with our 19-day advanced decline ratio, and we're just a little bit positive when we look at the 39-day advanced decline ratio. This is another major indicator, a primary indicator, because it tries to measure the institutional buying or the smart money, and it's continuing to go up, and it's above its moving average. So that is holding up rather well. Also, the chicken money flow, another smart money indicator, continues to go up. The real takeaway that I get from this was after Thursday's session last week, we had a down day, but this continued to go up anyway, and we're seeing it continue to go through. So this is positive. And the chicken oscillator is going up and is above 0, so that's positive. We're seeing a little bit of a tick down with the cumulative NYSE advanced decline line based on price, but barely a tick down based on volume. That could be taken as positive, where price declined more than volume. And we're seeing that kind of that same thing here, where not this chart, it'll be the next chart, where we did bounce up with this NYSE advanced decline line. This is where we're seeing a bit of a tick down with common stock on the NYSE, but we're seeing volume holding up better. Also, when we look at the S&P, a bit of a tick down when we do the cumulative price measure, where we actually advanced and was just pretty much unchanged when we look at this based on volume. That's more under the surface and could be taken as positive. And we're still above the moving averages with our advanced decline line studies, but we declined across the board here. Had an up day, but we saw the NYSE common stock, the S&P mid caps and small caps actually declined on the day. Here's our daily chart, and it's a little clearer now because we switched over to June with the new pivot levels. We just about came down to the 50-day moving average. We were able to get back above this pivot point, and this is looking pretty good for right now. We saw a lot of potential support areas all coming together at the same time, plus a round number like 5,200, and we were able to bounce up off of that. On the bottom, here's Friday's spike up in volume, and then we dropped to below average on Monday. We're looking somewhat positive in the short term with the stochastics. We're turning back up, but still negative in the intermediate short term. We're still extreme positive in the long short term. And this, I'm taking this as more negative. The double and triple exponential moving average for 20 periods, we were up, but we're still below the blue lines. We need to clear these for this short-term indicator to turn more positive. We tick down when we look at the 20, 50, and 200 period moving average study for the S&P 500. And we were still positive and a little above the midpoint when we look at the force index. We are above the 20 period simple and exponential moving averages. That's positive, and that's why I say the trend tends to be positive. I tend to base that around moving averages. We were able to reclaim these moving averages on Friday and still remain above them. We're above the midpoint with the standard deviations channel. That's positive. Intermediate term, we're just barely ticking back above zero with the balance of power. That's more positive. But now we're turning, well, I guess this is positive. This is a darker blue here, and that's more positive for the go, no-go system. We're slightly above the midpoint, and the midpoint is still going up with the highest high values, but we're still declining here with the TTM squeeze. We have the darker blue, and this continues to trail off. It hasn't turned negative yet, but it is showing weakness. And this is another area where we're just a little bit above the double exponential moving average. We were able to get back above the triple. If we can reclaim both of these and start to move up and see the lines start to go back up, that would turn the intermediate term a bit more positive. And we're watching the 50-day moving averages. We never got down to them last week. If we do see things really start to fall apart, we'll be watching this level. The ease of movement is above zero in advancing. That's positive. The Erin is showing a decrease here, where it's more of a decrease in buyers and a slight increase in sellers, but we're still positive since the oscillator is above zero. This is still negative with the S&P McClellan oscillator. We tick down and we're below zero. So the summation index based on price and volume continue to decline. This is one of my almost primary indicators. I used to have a whole system around just using the summation index, but then you get into non-trending environments, and this is pretty much a trend indicator. So then you need other indicators to bring along. The NYSE McClellan oscillator did decline, is still below zero. That's negative. So we're going down with the summation index based on price and volume for the NYSE. We saw a little bit of a tick up with the Swenlin trading oscillator, both based on price and volume, but we still remain below zero. In momentum, we're starting to roll over a little bit more with the PMO. We are negative when we break this out based on price and volume. Saw a bit of a tick down with the PMOs that are rising to slightly flat with the buy signals. We're still declining slightly with the PMOs that are above zero. Okay, let's try that again. We remain neutral with the Elder's Impulse system for the S&P with the blue bars. Here's another primary indicator. The parabolic SAR still has the dots on top. That's negative. The slope is no longer extreme and continues to come down, so the short-term momentum continues to be negative. And we're dropping further below the moving average with the MACD. This is more short to intermediate term momentum. So we're going down with the slope and the TSI. Those are our short-term oscillators. We're declining with the MACD. We're right on top of the moving average with the PMO, slightly negative there. Starting to cross below the moving average with the PPO, rolling over with the tricks, and just coming down to the moving average with the KST. But we're still above all the plotted moving averages here on our moving average tree. So that is positive. The bullish percent index is positive, but it continues to decline. And the NYSE bullish percent index also declining, but still above 50. This is negative. The NASDAQ 100 bullish percent index, it did tick up slightly, but is below 50. The money flow is above 50 and advancing. That's positive. The ultimate oscillator is above 50 and advancing. That's positive. And we saw a bit of a turn back up with the vortex. The green line turned back up. The red line is going down. So this is another primary indicator that I use that is now looking more positive. So we're seeing a lot of different signals currently. The RSI 14 is still above 50. That's showing good momentum. The RSI 9 is also still above 50. That's shorter term momentum. On balance volume is above an advancing moving average. We're still negative here with the stocks inside the S&P above their 20-period moving averages. We're below 50 and declining. So here's our study where we saw this nice little thrust up out of the April lows. And we saw kind of something like that a little over a year ago. And you can see what happened after that. We're wondering if that same kind of thing is going to develop this time. It hasn't really taken off, at least yet. We're just a little bit below 50 with our 50-period moving average study. So that's more negative in the intermediate term. And we're declining, but still above 50 with the 100-period moving average study. And we're declining with the 200-period moving average study as well. The Copic curve is negative with that momentum indicator. We tick back up, but we're not extreme now with the Sean trend meter. We're keeping an eye on this little mini rainbow. We're just at the very top right now. We were able to close just a little bit above it on Friday and a little bit above it again on Monday. We're turning back a little more positive with the Heiken Ashi. We have an open candle. We're pointing back up with the Kegi chart and it's black. That's positive. The Renko is positive and the 3-line break is also positive. So we're seeing some more confirmation there. Long term, we tick down with the 150 and 200. We're just a little bit extreme here with the 200-period moving average. And it looks like maybe June 4th, which will be Tuesday, the day that this video is being prepared for, it looks like that's lining up to be the end of the previous 50-day cycle. Sometimes that means something. We'll see if it ends up meaning something this time. We have not received a confirming signal yet with the Hindenburg Omen indicator. We had the initial spike. Now we're waiting to see if there's going to be another spike. We have 20 trading days to see if that will happen. We're negative with the mid caps and the short caps, the small caps, but we're positive with the other stock indexes that we follow. We're still negative across the board looking at the price of bonds. We're negative with commodities and the short-term trend of the dollar. This was changed, I guess, again here. They have the PMO actually being negative in the intermediate term, where with their trend models, they continue to be positive across the board. Here are the alerts where we had the real estate showing a BPI cross below 70. It saw some good strength last week. And then we saw some positive things happening. The S&P got above 5,300 briefly, didn't last. That ended up being overhead resistance. Then the NASDAQ chopping around. Oil, you might take this as positive right now. It's really starting to drop. It actually dropped below 75. And the tech sector, this could be negative. We crossed below 50 with the bullish percent index. Now, utilities, which have been really strong, they're dropping below 80 with their bullish percent index. So looking at our different sectors, healthcare had a good day. You don't see that on the leaderboard too much. This is a more defensive area, and I have a chart later on. We're just keeping an eye on this. Communication, a growth area, that was up, and tech ended up being up. The rest of the sectors were down, with energy leading the way lower, and utilities were also down over 1%. Looking at our equal weight, the big stocks did outperform, so we're coming back up a little bit here with our ratio from the S&P to the equal weight S&P. The Dow was down and is still below its 50-day moving average and still below this pivot point. We remain neutral with the diamonds when looking at the Elder's Impulse system. We were up a little over 0.5% with the NASDAQ, and this is looking a little better. We're still above the 50-day moving average, and the NASDAQ 100 was up 0.35% for a nice little up day, but not a real solid move. We've switched from being negative over to neutral with the QQQs when looking at the Elder's Impulse system. This is negative. The momentum for the NASDAQ 100 is crossing below its moving average. That's turning it negative. But when we look at the moving averages, we have a 20, a 50, and a 200 posted here. The QQQs, which is the NASDAQ 100, are above all of these moving averages. The small caps, they were down 0.5%. They were getting a little high up in their range, so naturally they had to come back down, but they're still above their 50-day moving average. We've gone from being positive over to negative with the Elder's Impulse system for the small caps. Here's looking at the Russell 2000 small caps, right about at 50 with the RSI, still above the 50-day moving average based on price. Longer term uptrend, shorter term, the momentum is negative. The mid caps came right down to this pivot point and right back down to their 50-day moving average. We're wondering if that will hold. We switched from being positive over to neutral with the mid caps when looking at the Elder's Impulse system. Here's a look at some of the big stocks. Apple was up 0.93%, and this may come back and actually cross over with a positive signal here pretty soon with the trend. Tesla was down over 1%, still above its 50-day moving average, still in a downtrend. Nvidia was up 4.9%, getting back some gains. They announced some new AI things over the weekend, and the markets really like that. Microsoft was down 0.39%, just a little bit under its 50-day moving average. And Meta was up 2.28%, but still below its 50-day moving average. Amazon was up 1% and still has a ways to go to get back to its 50-day moving average. And Google was up 0.39% and still well above its 50-day moving average. Netflix was down over 1%, but still above its 50-day moving average. The FANG index was up 0.75%, still above its 50-day moving average, still in a longer-term uptrend. And the financial sector was down. It's coming a little bit closer to its 50-day moving average, but still slightly above. Here's the ratio that we've really been keeping an eye on. Staples to tech, it bounced up. And we want to see this ratio go down if we're more positive on the market. The dollar was down, but is still in a longer-term uptrend. And we look at the S&P and compare it to the world index, seeing the shorter-term relationship remain fairly strong, not much of a change with the longer-term relationship. The staple sector was pretty much unchanged on the day. It came down to its 50-day moving average, bounced up off of that, but in Monday's session, it was down slightly. Utilities were down over 1%, but still looking pretty solid here. Keeping an eye on healthcare, it was up 0.72%. It's been able to stay for 2 days now above its 50-day moving average, and it's still in a longer-term uptrend. And energy saw a decline, 2.64% for the sector. We're below the 50-day moving average. Total U.S. stock ETF, we were unchanged on the day. Keeping an eye on the yield, we saw the 10-year really drop, and that could really give some stimulus to stocks, where the 10-year based on price did go up. And then looking at our growth to value ratios, not seeing anything too crazy here. The Qs to S&P right about on the moving average, but the moving average is slightly going higher. Discretionary to the S&P is still showing us weakness, and that's not looking very good. Large cap growth to large cap value, we saw a little bit of a tick up above a rising moving average. So a little bit of an improvement with the large caps, but we're seeing more weakness with the mid caps and the small caps. Keeping an eye on our 10-day average of the S&P 500 highs minus the lows, we're still coming down after being extreme positive for most of 2024. This is showing a mixed picture as well, where we're slightly negative with the 19-day advanced decline ratio based on price. We're slightly positive with the advanced decline ratio based on volume. So that's where we're seeing volume leading just a little bit and looking a little more positive. The S&P to utilities ratio continues to decline. We want to see this go up to be more positive on the S&P. And the staples to S&P 500 ratio, we want to see this decline. It ticked up in Monday's session. So what's our outlook for Tuesday? We're still positive when you look at it based on moving averages, but we're getting a lot of mixed signals with the parabolic SAR and the ADX. Those are pretty significant indicators that are flashing negative signs right now. So this weakness continues to develop, but we still have positive seasonality for right now. We're going to get factory orders and the JOLTS job openings in Tuesday's session. We want to keep an eye on all the different events that are going on. And then in Wednesday's session, we're going to get the ISM non-manufacturing. That'll be the other big complementary to the manufacturing report that came out on Monday. The big one is going to be the employment situation report on Friday. And here's the JOLT job openings. They seem to think that that one is pretty important there. Seasonally, we're positive across the board for June 4th with the Dow, S&P, and NASDAQ. Tuesday is kind of unchanged when you go back to how things performed in 2023. Here's an updated version of this chart showing that we are in a series of days with positive seasonality. We follow the green dashed line, and according to seasonal tendencies, we tend to go up until about the 6th trading day, which will be the 10th of June. And then looking at this, if you take out the sitting president not running in 2020, that's where they get a closer correlation here between what they think will happen with what has been happening now. This has also been updated. We're well above what normally happens, but this is also producing some potential positive seasonality. And then this, I had access to this chart, so I just wanted to show it. This is the NASDAQ, and this is what a lot of people are anticipating. And we've seen this on a seasonal basis where June tends to be okay for the NASDAQ because that's more tech. But then we see a bit of a bounce when we go into July, and then some weakness, and then more strength as we go later on into August. And this is election year, summer chop ahead of conventions. Okay. And then I did get the June report from Tom Bowley, where June is an underperforming month, where you have the materials, they are not strong, where you have the staples tend to be strong. Or is that discretionary? Anyway, it's really choppy. We're kind of in a positive time right now from the 1st through the 6th. Then we go into a negative time, then a positive time, then a negative time, and then we drop back into a more positive time. So the warning signs, we're still working off this idea that when the S&P was making its new all-time high, staples and utilities were doing well, and that can be a warning sign. That's a defensive measure. We haven't really seen that played out yet, other than early weakness during the day, but then late day strength coming in. This is just a warning sign that we want to be aware of. We're also keeping an eye on energy as well as healthcare, where healthcare is one of the more defensive areas. Energy can be defensive at times. The growth to value and discretionary to staples ratios, they're just not leading right now. Not what we really want to see in a good solid environment. Both the S&P and NYSE McClellan oscillators are negative. The oscillators for the S&P are turning more negative. The short and intermediate term are looking more negative. We haven't quite crossed with the long term. The Swenlin trading oscillator is negative. Parabolic SAR is negative. The Copic curve is negative. Our 20 and 50 moving average studies of those inside the S&P, they are negative. And the S&P and NYSE summation indexes are also declining as well. I should have put that up here with the McClellan oscillator since they go more hand in hand. And the bullish percent index for the NASDAQ 100 is negative. And the momentum, this is a new addition to this list. It's now crossing below its moving average. So then on the positive side, the advanced decline lines, they are showing some weakness, but they're still above their moving averages. And to have the S&P close up, but most of the advanced decline lines decline slightly, that's a slight negative divergence. Our equity put call ratio based on 5 periods is now turned back down. That's positive. We do have a lot of positive indicators still, like the bullish percent index. It's above 50, but it's declining. The accumulation distribution, this is kind of a big deal right here, that's positive, as well as the Chaikin money flow and the Chaikin oscillator. These are smart money indicators. The money flow index, the ultimate oscillator, those are positive. The vortex, another primary indicator, it's turned back up after the red line and the green line were right on top of each other. And the financial sector continues to be positive. So our conclusion, we're positive if you want to look at it that way. If you are more negative, you could justify having that stance as well, because we're getting some mixed signals as the weakness continues to develop, and we're seeing a bit more of that weakness more in the intermediate term, not as much in the short term, but we do have positive seasonality. We're seeing that weakness that is developing in the short term with positive seasonality. Intermediate term, we are still positive, but there is weakness there, and we're still positive in the long term. Thank you. I really hope you found this helpful. I hope you have a very good day, and I will talk to you in the next video.